We are at stage 5, and stage 5 tends to move fast once the cost of the next repair becomes visible to the people being asked to pay for it. There is a number that most Americans have never seen, and it is not hidden. It is published every single business day on the U.S. Treasury's own website, updated in real time, sitting in plain sight on a government server that anyone can access from their phone. It is the interest payment the federal government made today, not the debt itself, just the cost of maintaining it. And for the first time in the country's modern history, that number is approaching, and in some projections, has exceeded what the United States spends on its own defense. That is not a political statement. It is an accounting entry, and accounting entries do not care about elections. In 1944, 44 nations sent delegations to a resort hotel in New Hampshire, and over 3 weeks, designed the financial architecture that the entire world still operates inside. A system built on the assumption that one country's productive output would remain the load-bearing structure of global trade indefinitely. In 1971, that assumption was quietly renegotiated, not through a summit, not through a vote, but through a Sunday evening televised announcement that most Americans remember, if at all, as something that happened before they were born. In 2008, the cost of the renegotiation became visible for the first time. $700 billion in emergency repairs. The building preserved, the structural question deferred. We are at stage 5. Not stage 6, not a collapse. A specific position in a documented sequence that has appeared in different countries, in different centuries, under different political systems, and that sequence has a name. It is called the Dependency Staircase, and understanding where you stand on it changes how you read every economic headline you will encounter for the rest of your life. If that framework is worth something to you, subscribe now, because the staircase only becomes visible when you know what you are looking at. And the next section is where the structure underneath the headlines comes into focus. A system built on debt dependency doesn't announce itself. It accumulates quietly, the way a homeowner discovers that the slow leak behind the drywall has been running for 3 years. Not because anyone was negligent, but because the structure was designed to keep the visible surface intact while the pressure built somewhere out of sight. That is the first thing to understand about the dependency staircase. It is not a theory about what might happen. It is a description of a process that is already underway, that has been underway for decades, and that looks from the inside exactly like a normal economy functioning under normal pressure. The system type here is what economists sometimes call a policy dependency cycle, though that phrase flattens something that deserves a clearer image. Think of it this way. When a regional airline starts losing money on a route, it has 2 options. It can exit the route, absorb the short-term loss, and redeploy its aircraft somewhere productive. Or it can apply for a federal subsidy, keep the route running, and defer the structural decision to the next quarterly earnings call. The subsidy is not irrational. It preserves jobs, maintains service, and costs less than the political fallout of closure. But the subsidy also changes the airline's operating model in a way that is very difficult to reverse. Because now the route's viability is not a function of passenger demand. It is a function of continued subsidy availability. The airline has not fixed its cost problem. It has replaced a market dependency with a policy dependency. And policy dependencies, once established at sufficient scale, do not dissolve quietly. That substitution, productive activity replaced by policy-sustained activity, is the mechanism at the center of the dependency staircase. 6 stages. Not a prediction, not a cycle that repeats on a fixed schedule, but a sequence that has appeared across enough different economies, under enough different political conditions, that the pattern deserves a name and a structure. Stage 1 is productive expansion. This is the phase that economic systems are designed to sustain indefinitely, and the phase that every major policy framework is nominally oriented toward returning to. An economy in stage 1 grows by producing more than it consumes, and the surplus finances future investment without requiring the next generation to service the debt of the current one. The psychological texture of stage 1 is confidence, not euphoria, not overreach, but a generalized sense that the system's promises are credible and that deferred effort will be rewarded. Think of the 30-year window between 1,945 and 1,975 inches. The United States, when a manufacturing worker with a high school diploma could purchase a house, raise a family, and retire with a pension that paid what it promised. The math worked because the productive base was expanding faster than the obligation base. That relationship is Stage 1's defining characteristic. Stage 2 is leverage normalization. This is the phase that feels like growth but is partly borrowing against future growth. Debt becomes a standard operational tool, not emergency financing, not reckless speculation, but the normalized infrastructure of expansion at every level of the economy simultaneously. Corporate debt, consumer debt, municipal debt, sovereign debt, all expanding together, all individually justifiable, all collectively shifting the system's center of gravity toward an obligation-forward posture. The everyday image for this stage is the shift in American corporate financial culture that accelerated through the 1980s and 1990s. When the preferred measure of a company's health moved from productive capacity to return on equity, and return on equity could be mechanically improved by borrowing. Stage 4 is policy substitution. This is the phase where the gap between nominal growth and real productive expansion becomes large enough that market mechanisms alone can no longer sustain the appearance of stability, and public policy steps in as the sustaining variable. Interest rates are cut, spending is increased. The central bank becomes an active participant in asset valuation. The government becomes, in structural terms, the buyer of last resort for economic activity that private capital has stopped funding at sufficient velocity. The tension question for this stage is one that most people in Stage 4 economies never think to ask. If the policy is doing the work that productive growth used to do, at what point does the policy become the economy rather than a support for it? Stage 5 is obligation dominance, and this is where the United States currently operates. The cost of servicing prior commitments, debt interest, entitlement obligations, institutional overhead has grown large enough to crowd out new productive investment at the margin. The system is not failing. It is running, but it is running in a way that prioritizes the maintenance of existing obligations over the creation of new productive capacity. The everyday image is a 54-year-old carrying 3 revolving credit balances, a home equity line taken out in 2019, and a retirement account that has underperformed inflation for 2 consecutive years, making minimum payments on debt that was originally incurred for purposes that no longer exist, the renovation that was sold, the vehicle that was totaled, the tuition for a degree that didn't produce the income the model assumed. The payments are current. The math does not lead anywhere new. Stage 6 is structural reset, and it will be described here only in outline, because the specificity of prediction is not the point of this documentary. What can be said is that Stage 6 is the phase in which the system can no longer service its obligations at the current rate of growth without repricing something fundamental: currency, debt, assets, or the political structure that governs all three. What gets repriced, and how quickly, and who absorbs the cost, is the variable. The mechanism is not. The paradox underneath all 6 stages is the same one that runs through every case study that follows. Every step down the staircase was taken voluntarily, and every step felt, at the moment it was taken, like the responsible choice available. The first case is not American, it is Ottoman, and it begins in 1854 with a war. The Ottoman Empire in the mid-19th century was a sophisticated, functioning state with a complex administrative apparatus, a diversified regional economy, and a fiscal system that had operated without foreign debt for centuries. The Crimean War changed that. Facing military costs that the existing revenue base could not absorb at sufficient speed, the Ottoman government issued its first foreign-denominated bond on the London market in 1854. The transaction was not irrational. It was the financially sophisticated response to a short-term liquidity problem. The bond was serviced, the creditors were paid, and the channel, once opened, did not close. Through the 1860s and early 1870s, the Ottoman government returned to the European bond markets repeatedly, for infrastructure, for modernization, for the ongoing cost of maintaining a state whose administrative complexity had grown faster than its tax base. Each issuance was defensible. Each one added to an obligation structure that was compounding in the background, while the government's productive revenue base grew more slowly. By 1875, debt service consumed 58% of Ottoman state revenue. That number did not trigger a crisis in itself. It simply became the operating reality, the new baseline around which every other fiscal decision had to be organized. In 1876, the Ottoman government suspended payments on its foreign debt. The European creditors did not accept this quietly. Over the following years, a negotiated resolution took shape, and in 1881, the Ottoman Public Debt Administration was formally established. It was a foreign-controlled body, staffed largely by European creditor representatives, authorized to collect specific Ottoman tax revenues directly and apply them to debt service on behalf of the bondholders. The Ottoman state continued to function. Its flag still flew. Its bureaucracy still operated. But a meaningful portion of its fiscal sovereignty, the ability to direct its own revenue toward its own priorities, had transferred to an external administrative structure, not through conquest, through the accumulated logic of debt obligation. A tax collector in Anatolia in 1882 collected grain levies from wheat farmers in the interior. That revenue traveled to Constantinople, then was routed to the Public Debt Administration, then transferred to Paris and London. The farmer was paying for a war that had ended 27 years earlier, to creditors he had no awareness of, through a mechanism his own government did not control. The commitment had been made before the bill arrived. The second case is Japan, and it begins in 1990, and it has not ended. Japan in 1989 was the world's second largest economy, the holder of what appeared to be the most sophisticated long-term industrial policy in the developed world, and the subject of serious academic and governmental analysis in the United States regarding whether its economic model represented a superior form of capitalism. Its real estate market had appreciated to the point where the land beneath the Imperial Palace in Tokyo was estimated to be worth more than the entire state of California. That valuation was not a market signal. It was a pressure reading. When the bubble collapsed in 1990, equity markets and real estate simultaneously, the Japanese government and financial system faced a choice that every Stage 5 economy eventually confronts. Allow the repricing to occur, absorb the institutional failures, and accept a period of severe contraction in exchange for a reset to a productive baseline. Or deploy policy at sufficient scale to prevent the repricing, preserve the institutional structure, and manage the adjustment gradually over time. Japan chose the second path. Banks were kept solvent through regulatory forbearance. Companies that could not service their debts were carried by the banking system rather than resolved. Interest rates moved toward zero and stayed there. The government ran persistent fiscal deficits to sustain demand that private investment was no longer generating. The system was preserved, and it has remained in Stage 5 for 35 years. The cost of that preservation is not dramatic. It does not appear in a single catastrophic data point. It appears in a 38-year-old in Tokyo in 2005 who earns approximately what his father earned in 1988, lives in an apartment whose value has not appreciated in 17 years, and holds his savings in a bank account paying interest so close to zero that the number requires a decimal point and 3 zeros before it becomes legible. He did not make poor decisions. He did not choose this outcome. He entered an economy whose institutional structure had been optimized for 15 years before he arrived in the workforce to prevent repricing rather than enable growth. The system was stable. The future it was supposed to fund had quietly contracted. Japan's government debt, sustained across those decades of intervention, reached 260% of GDP, the highest ratio in the developed world among major economies. The bonds were serviced, the institutions functioned, and the economy delivered consistently, an experience that the economists who designed the stabilization policy had not fully modeled. Not collapse, but compression. A slow narrowing of possibility that does not announce itself as a crisis because it never produces a single day that the third case is included for a specific reason that the Japan case raises but does not answer. Japan shows what Stage 5 looks like when institutional buffers are deep enough to slow the descent indefinitely. But the buffer is the variable, not the mechanism. To see the mechanism without the buffer, the case is Weimar, Germany, 1919, and it is not here as a prediction. It is here as a speed case. The Weimar Republic inherited a set of obligations it did not create, in a political structure too new to have institutional credibility, with an industrial base partially dismantled by treaty and a currency whose international standing had been fundamentally damaged by the war's financing. The reparations demanded by the Treaty of Versailles were not the only pressure. Domestic social spending, demobilization costs, and the political requirements of a fragile new democracy created an obligation structure that exceeded the productive capacity of the economy from the first day of the Republic's existence. The policy response was, in structural terms, Stage 4 applied without a buffer. The government monetized its debt, printed currency to meet obligations it could not fund through taxation or borrowing, because no alternative was politically survivable in the short term. The mechanism was not irrational given the constraints. It was the logical output of a system that had been placed at Stage 5 or beyond before it ever had the opportunity to pass through the earlier stages. By November 1923, a loaf of bread cost 200 billion marks. That number is not the point. The point is that the number was a policy output, the measurable result of a decision-making sequence, not an accident or an aberration. And inside that number lived an ordinary person making perfectly rational choices. A schoolteacher in Munich in August 1923 received her monthly salary on a Friday and spent every mark by Saturday afternoon, not because she was impulsive or financially illiterate, but because anyone who waited until Monday lost 40% of the purchasing value of what they held. The behavior that looks irrational from the outside was the only sensible response available from the inside of a Stage 6 system. The rationality of individuals had not changed. The structure they were operating within had changed around them, faster than their institutions could adapt. Weimar is not a forecast for the United States. The institutional buffers that Japan possesses, and that the United States possesses to a greater degree, reserve currency status, deep domestic bond markets, institutional credibility accumulated over a longer history, are not decorative. They are structural absorbers that slow the transmission between stages. What Weimar illustrates is not the destination, but the mechanism. Stage 4, applied without buffers, produces Stage 6 at a speed that the society inside it cannot process. The buffers matter. They are the difference between the Japanese timeline and the German one. But buffers are not infinite, and they are not self-replenishing. 3 cases, 3 distinct outcomes: administrative capture, permanent stasis, rapid repricing. The staircase is. Before mapping this model to the present, it is worth pausing on what has just been established, because the cases cover enough ground that the through line can become blurry. The dependency staircase has 6 stages. The United States, by its own published data, is operating in Stage 5, obligation dominance, not because of any single policy failure or political decision, but because of the accumulated weight of commitments made across decades that now cost more to service than the economy's current growth rate comfortably absorbs. The Ottoman case showed Stage 5 at the sovereign level, resolved through administrative transfer. The Japanese case showed Stage 5 self-managed across 35 years at the cost of generational compression. The Weimar case showed what acceleration looks like when the institutional buffers are insufficient to slow the transmission. Every case looked different from the outside. From the inside, every case felt like a system under manageable pressure, right up to the point where the pressure crossed the threshold that the structure could contain. That is where the U.S. indicators become worth examining, not as alarm signals, but as position readers. The signals that confirm Stage 5 in the United States are not hidden. They are in the published data, visible to anyone who knows what they are measuring for. The first is the one mentioned at the opening. Net interest on the federal debt is approaching, and in some projections has exceeded, annual defense spending. This is not a political argument about spending priorities. It is a structural observation about where the government's dollars go before they reach any discretionary decision. A dollar committed to interest payments is a dollar that has already been spent, in the present tense, on an obligation created in the past. The share of the federal budget that is structurally committed before any policy choice is made has been expanding for decades and is now at a level that constrains every other fiscal option the government possesses. The second signal is in the corporate debt refinancing structure. Through the period of near-zero interest rates that followed 2008 and extended through 2021, American corporations issued debt at rates that made the obligation feel almost costless. That debt did not disappear. It matured, and a significant portion of it is now refinancing at rates that are 2, 3, and in some cases 4 times higher than the original issuance. The commercial real estate sector carries a particularly concentrated version of this pressure. Loans written at 2021 valuations and 2021 rates, now requiring refinancing in a rate environment that the original underwriting did not model. The question this creates is not whether individual loans will be renegotiated. They will. The question is what the cumulative effect of that renegotiation looks like when it processes through regional banking balance sheets simultaneously. The signal that tends to get dismissed as soft data, but which the staircase model treats as structurally significant, is institutional confidence. Gallup's long-running surveys show trust in Congress, banks, and the medical system at or near historic lows, not following a single dramatic failure, but following a prolonged period in which the gap between institutional promise and institutional delivery became wide enough to be felt at the household level before it was measured in the survey data. That gap is a Stage 5 characteristic. Institutions in Stage 5 are not failing visibly. They are delivering less than the commitments implied, consistently enough that the shortfall becomes the expectation rather than the exception. The tension question for this section is the one that the indicators collectively raise without answering. If the cost of maintaining the system now exceeds its productive return, not in catastrophic terms but in structural accounting terms, at what point does maintenance become the economy's primary industry? What moves a Stage 5 system towards Stage 6 is not a single event. It is a credibility threshold, the point at which the next intervention required to sustain stability costs more, in institutional terms, than the market is willing to absorb without repricing its assumptions. 3 candidate mechanisms are worth holding in mind, not as predictions but as structural possibilities. The first is what might be called liquidity friction. The moment when rolling over existing debt requires a yield premium that the system cannot absorb without visibly displacing other spending. The refinancing wall becomes the floor. The cost of the past crowds out the financing of the present in a way that becomes impossible to manage quietly. The second is policy exhaustion, the point at which the standard toolkit has been deployed at sufficient scale that markets begin pricing in diminishing returns on future deployments. Not distrust in a single institution, but a recalibration of confidence in the policy mechanism itself. When the intervention is expected and priced in, it loses the capacity to surprise. And the capacity to surprise is where a significant share of the intervention's effect actually lives. The third is what might be called trust dislocation, a broad repricing of confidence in institutional promises that does not require a triggering event, only an accumulation of disappointment sufficient to change the baseline assumption. The retirement auto-enrollment model holds as long as new participants are being defaulted in faster than existing participants are opting out or drawing down. When that ratio shifts, not dramatically but structurally, the arithmetic of the system changes without anyone making a decision to change it. The transition from Stage 5 to Stage 6 does not require a catastrophe. It requires only that the cost of the next repair exceeds what the system can quietly absorb, and that the people whose confidence underwrites the system's stability begin, gradually, to price that possibility into their decisions before it has been publicly acknowledged. 3 positions are available to anyone who understands the staircase, and they deserve more than a passing mention. What matters here, before the conclusion, is a simpler observation. The position you occupy inside a structural system determines which questions you are even capable of asking about it. A person who does not know they are in Stage 5 will spend their analytical energy explaining symptoms. A person who does know will spend it reading trajectory. The difference between those two postures is not optimism or pessimism, it is precision. And that distinction is where this documentary ends, and where the clearer thinking begins. By now, the sequence is familiar. not because it has been repeated, but because it has been documented across 3 continents, 3 institutional architectures, and 3 very different speeds of descent. The system does not care whether you believe in it. That is not a warning. It is the same observation you would make about a mortgage amortization schedule or a retirement account's required minimum distribution table. The arithmetic runs whether or not the person whose name is on the account has read the document. Structural processes are indifferent to the attention of the people they are acting upon. 3 positions remain available. The first is to drift, to continue operating inside stage 5 as though the friction it produces is random, temporary, or the result of decisions that could simply be made differently by different people in different offices. Japan demonstrates that this position is sustainable across a remarkably long timeline, and for many people, it will remain the practical choice. The second is to react, to treat the structural signals as a call to urgency, to position defensively against a transition whose schedule is not legible, and to absorb the cost of being early to a reckoning that may arrive on its own timetable. History does not reward that position reliably. The third is to understand the structure well enough that the symptoms of stage 5 stop reading as surprises, that the institutional trust data, the obligation math, the return compression visible in the median household's actual experience, all become position readings rather than anomalies requiring explanation. Consider a family that has lived in the same house for 22 years. They know which floorboard creaks, which window sticks in July, which circuit trips if the kitchen and the garage run simultaneously. They are not alarmed by these things. They have mapped the structure they live inside. That is the cognitive posture this documentary is built to support. Not alarm,